Well, there it goes. Hi, Dean Jenkins with FollowMeTrades.com, and this is the market update for the week coming up of November 18th, 2019. And there it goes. This is the S&P 500, and off to new record closing highs last Friday. And not just a little bit, a really, really impressive breakout to new highs. You know, for the couple weeks after it broke out of the previous channel, it was creeping up, and then Friday, clearly a breakout. And so the market's heading up, and that's the reality. And, regardless of what what I'm concerned about and what I think maybe should be happening, the reality is, hey, the market's up, and it's up big time to new highs, not just the S&P 500, but all the major indexes. So, hey, we try to stay focused on reality, trade the realities, and I am trading that way. I've still got some downside, some short trades, but predominantly I am long because that's the current reality, and that's where I want to exist. Let me get my chart back right to the S&P 500 chart. I do want to point out a couple things here that are interesting. So the S&P 500 year to date, according to CNN Business, is up 24.48%. We can just call that 25%, which is a good year no matter how you slice it. But let's dig into that just a little bit. Part of the reason it's a big number is, I don't want to say it's not, but part of the reason is, we had a dramatic drop at the end of last year, and so 2019 was starting at a kind of a retracement level, a low level, and so it's from that level up to this that is the, we'll call it 25%. In terms of the gain from the prior high, nowhere near that big of a number, and that prior high was only 2 months before, the beginning of the year. So that's some context. No question, it's been a big bull market year, but also, then the 25% is a little bit artificial, just given that huge drop at the end of last year. So I did want to, again, in the spirit of being focused on reality, point that out. Let's look at something else here that's interesting. So I've drawn a line here because there's been 4 rallies that were fairly similar in terms of duration and price. So I've drawn this blue line here to show this rally from early March to May. And then if we move this over to this rally, in terms of time and price, I think we can call that very, very similar. And then the one in August, now this one fell a little bit short, but now we lay this line over the current rally, and we can see, again, time and price very, very similar. And so now let's take a look at the pullbacks after those moves up. So I've drawn a red line here on the first pullback, and then we move it. We go in terms of time and price. There's some real similarity there. This one, just like the up move, a little bit different, but, is that the next thing? Even if this is going to be an ongoing rally, a pullback would take us, higher than here. So it would be this ongoing bull market that we see here of higher highs, higher lows, higher highs, higher lows, right? That's an uptrend. And this, a bit of an anomaly here, is it stayed in this channel that we've talked about in the past, but overall, pretty clear uptrend. So this is called symmetry, when there's very similar time and price movements up and down. It's called symmetry, and symmetry is good until it isn't. So these patterns tend to repeat themselves for a while, and then they break down and something new happens. So I just thought that was interesting to show. We do have symmetry in time and price, both for the up moves and the down moves, and that's something to watch for. Clearly no sign, but these didn't give much warning before they had a pretty sharp pullback. So could that happen again? Absolutely. And if it does, we're going to try to capitalize on that. So, again, my trading is based on the realities, what's actually happening, not what I believe should be happening. But it's always important to be thinking about, why did this happen and what could make it change? Well, the primary reason for at least the recent move up here, two primary drivers for that. We could say three. First, the Fed cutting interest rates, that was seen as positive. Better than expected earnings in the S&P 500. Overall results are coming in better than expected. Companies that are exceeding expectations are doing pretty well. And the current environment has zero tolerance for earnings miss. So the companies that do miss get just absolutely punished. So we got the Fed cutting interest rates, that's seen as positive. We got pretty good earnings results, better than expected in the S&P 500. And then the prospect of, a phase one trade deal with China. So what could make this fall apart? Well, the Fed has signaled they're probably not going to do anything in the rest of this year, maybe early into next year. Earnings are what they are. We're on the back end of earnings season, and it'd be hard to change this overall, kind of net better than expected earnings. So the China trade deal, we could ink that phase one deal, and that would all be good and probably drive the market higher. And it could also break down, right? These negotiations have been notoriously difficult. Is probably the best word. And so they could break down, and that would probably cause a pretty significant market drop. We've got the impeachment hearings ongoing. We don't take political sides here. We don't offer political commentary, but in reading several articles, what you see probably depends on where you stand vis-a-vis, ideology and political sides. But, kind of the net result, the scorecard of the impeachment hearings, as the best I can determine from multiple sources, is kind of there's 0 points on the board, or net 0 points on the board there for either team. And again, I don't want to devolve into political debate, but it affects the market. And so a bombshell finding in the hearings, that would increase the probability of impeachment and, big enough to make it get through the Senate. That would be a really, really big deal for the market. So, that could happen at any time if it would happen. And so I think those are the big deals right now. Earnings are kind of done. Difficult to change that trajectory. The Fed's not going to do anything more the rest of this year. And so it's going to be about the China trade deals and, again, any potential bombshells in the impeachment hearings. We've got a slew of economic reports coming up next year. None of them individually will move the markets, unless there's a collection of bad news that starts to show some weak underpinnings for the economy, the potential of recession. That could accumulate, too, into something that then erodes confidence and causes the market to go down. So, meanwhile, hey, the technicals and the reality is market's going up, and we're going up with it until it ain't. And that's where we stand. So hopefully that gives you some food for thought, some things to think about and watch for in the upcoming week and beyond. As always, I welcome your comments, your questions, and your feedback. Let me know where you're at, what you think. All right, take care. Catch you next time. Bye.